Today I'm taking a look at Sainsbury's. Sainsbury's is a business combining the well-known grocery store chain, which started over 150 years ago, Argos stores, which they took over a few years ago, which is a very diverse sort of hardware retailing and things for the home retailer, virtually and everything, and absorbed a lot of the independent Argos stores into Sainsbury's shops, and I think that process is still very much ongoing. And some of the standalone Argos stores have been closing and just absorbed into the nearest biggest Sainsbury's they can find. Uh, Two is the clothing range for Sainsbury's. Habitat is a slightly more upmarket homeware retailer, really. So anything from sofas to table lamps to all sorts of things. So there seems to be quite a crossover between some of the Habitat products, which are a bit more upmarket, and the Argos product. Sainsbury's Bank and Sainsbury's Energy and Nectar as their points or point spin prizes brand, so you can earn some extra pennies shopping at Sainsbury's and then spend that with other retailers or with Sainsbury's. So let's take a look at the recent results. I'll put them into the chart format as usual. The good news for this year is that the profitability for Sainsbury's is actually up over the last year. Saw a virtually non-existent profit in 2020 and a small loss in 2021, but this year has returned to the best profit for quite a few years. Now, this is very much a business that relies on absolutely enormous turnover, very tight margins. So the net profits are usually relatively, well, really tiny compared to the actual amount of money that the company turns over. Assets versus liabilities. Liabilities seem to have gone up over the 2020 and 2021 period, and just stayed on a par with that level in 2022, reflecting the Rona hit. The supermarket trade seemed to do relatively well in that. It's been a consistent business because still people need to eat, and maybe we're spending a bit more money on their home. I think the things going forward in this for Sainsbury's is that although the grocery side will do well, they're still obviously still fearing competition from the budget retailers like Lidl and Aldi. But I think if Sainsbury's stick to its quality and value message, the Sainsbury's customers will remain very loyal to Sainsbury's going forward. However, I think we're going to see some food supply problems probably later in the year. We've seen McDonald's having to cut down to one slice of tomato in the burger because there's a tomato shortage at the moment, and the problems elsewhere in the world may mean that wheat and other products will become in short supply later in the year, and I think that will affect maybe what will be available on the shelves. So that'll be certainly a factor to bear in mind. Also, with the cost of living crisis, Sainsbury's have been congratulated for being the first employer to really up the wages in London dramatically for its staff, and also increase wages across the UK for its staff, very much in line with the cost of living crisis that's going on. They really want to look after their employees as best as they possibly can. So capital expenditure in the last year has been down. I think it's the capital expenditure may have been part of the reasons why Sainsbury's achieved a profitability in the year, because they weren't necessarily laying out on work in the either refurbishing stores or expanding into new ones, and that might have given them the better bottom line on the profit for the end of the year. Just a guess, but I think it might not be too far off the case. Free cash flow, though, even though they've turned in a much better profit than normal, free cash flow is heavily down in 2022. So, looking at the discount cash flow calculation based on the information provided, now this is based on figures of a 30% growth rate from Yahoo Finance. It might be a little optimistic. Simply Wall Street is predicting a zero point 0.2 minus growth rate for the next few years for Sainsbury's. But on this fact, the discount calculation here, it's coming out with a free value there at 3.49 a share compared to the current price at 2.29, which has actually been falling over the last few months. So compared to the Simply Wall Street valuation at 462 a share, not quite sure how they work out their figures, compared to 233. So looking at the looking at the SharePad graph for Sainsbury's over the last 3 years, we've seen a rising in the price up to around about that 340 mark there, and it's slowly been dropping right back down again. We had low figures at there we go, an all-time low 171, 182. So if the share price is dropping, and that seems to be the trend for the moment, I would be predicting it might be reducing down to these lower figures here over the coming few months or so, possibly before turning around. But at Sainsbury's, I think, as many people see, it's a very safe stock in the portfolio. This company's not going to go broke. It's not currently in my portfolio, and however, for investors wanting and maybe looking at a safe play, Sainsbury's is not a bad bet, really, is it? So look forward to seeing your comments in the comment section below, and we'll catch up with you again soon.